Good afternoon. Welcome to our today's class with the subject support and resistance. All of us heard about these words. They are quite common, and this is something of that marks the basics of technical analysis and trading itself, because just talking about support and resistance, we talk about some very important levels in our trading, which could stop uh, existing direction of the price action, or can be broken and signal continuation. In any case, they're important things, and we're going to talk a bit more about this, about what is it, what are the types, how to plot them in the chart, how to recognize them, and the most important, how to use the support and resistance levels, as a number of forex traders and generally market traders use support as resistance as one of the key points in making trading decisions. So let's take a look and see what and how it works. So the definition of support and resistance is that these are the areas in the chart where the price faces difficulties to break through. So when the price action moves either direction, no matter whether it's uptrend or downtrend, it just changes the name of the significant level. Support usually makes an obstacle to the downtrend, and resistance is the obstacle in the opposite direction, so in an uptrend. Once the price approaches these levels, it could pose there. Usually, we say faces headwinds, depending again on the strength of the level support or resistance, and may stay in some consolidation before making a final decision. Let's call it this way. So either it will change direction at these points, in other words, reverse, or it's going to break and continue existing direction. Support levels mark an obstacles for the downtrend, for falling price, which attack these levels in attempt to break lower, while on the other side resistance levels are tending to stop rising price and uptrend from breaking above. Now the strength of the each level depends how much difficulties the price will have to break it, and we know that we recognize actually various types of support and resistance levels, and depending on their strength, price shows different behavior. Sometimes when it approaches strong support or resistance, it might show strong hesitation there. It might enter consolidation. It may bounce higher, but without showing a clear signal of reversal. So the price action may stay for some time there, testing several times before making a so-called final decision. So whether either it's breaking through or it's changing a direction. The traders usually try to take advantage of this and jump in the market, depending, of course, on the signal which will be generated on significant support and resistance levels. As we know, the markets do not move in the straight line, but rather in waves, in forming different patterns. So we can see in this diagram, it's just a basic picture how it looks. So when the market starts moving up, it faces certain point where it we call it runs out of steam. It could be running out of strength, of momentum. Could be some trend line. Could be some previous historical high. In any case, this marks obstacle for that leg higher, and the price moves lower. Now, the strength, the move lower will find the next significant level which works in the opposite direction, marks support. Again, it could be one of a number of things that could offer support, and again, depending on the strength of that level, the market will either break lower or reverse higher and continue its original direction. Next level is again the same. So basically what we can see is an uptrend. So uptrend is having its waves up and down, its swings up and down, but the general direction is still to the upside. So we can draw here even the line and show that this price action is in uptrend, and its waves mark the support and resistance levels, which are a good opportunity for traders to jump in. So let's say those short entering short against the general trend will be selling here. Then once the resistance support shows that it was not, basically it resisted the attack and the price continued higher, the traders will jump in and look to buy. The same situation is in the downtrend. So we have initial direction which is down, faces support, swing higher, resistance, then continues lower, again resistance, and continues its direction. So it means that this is a clear downtrend, and the traders will be again taking advantage of these correction actions to get better price for entering. So if you are selling with the downtrend, and then you can see the support and the price starts moving higher, obviously you will come out of your short position and wait for a better opportunity to re-enter if the market will show that it will continue its initial original direction. So you'll be waiting a reaction on this resistance. Once it shows that it's not broken, that it has enough strength to contain these attacks, it will start moving lower. Then you will get signal to re-enter the downtrend and increase your profit, and the similar thing happens further. So these are what is the basically I wanted to say that the concept, this concept is quite popular, and it's as I said at the beginning, it's one of the basis of the technical analysis, and it's popular and widely used concept in the Forex trading. So support and resistance, what are these points? You can see in the in your screen that it could be marking historical highs, historical lows, or recent highs and lows, reversal points. It could be trend line. It could be Fibonacci retracement levels. It could be Fibonacci expansion levels. Anything from to do with Fibonacci. Could be technical signals on overbought or oversold situation, when we mention in our daily comments that conditions are overbought, strongly overbought. So it means that the market will likely correct something, and this area now it's a potential resistance in case of uptrend, as it's overbought, pardon. So we can expect something to happen in the opposite direction. Then we have various candlesticks patterns that usually could signal either trend continuation or a reversal. And we have technical indicators such as moving averages, for example, which track the price and usually signal good support or resistance levels. The moving average itself, or crossing of the faster moving average above or below a slower moving average, which creates a bullish or bearish cross. It's another type of support and resistance, and traders usually follow all these things. You have also Ichimoku studies, for example. Traders follow all these things and find to recognize these levels and compose them into their trading plan. So they have already they already see the levels which could be obstacle for the direction, and could provide them fresh opportunity or better opportunity to enter the market. So basically is if the support holds the action, the move, initial move, in this case to the downside, then there is a buying signal. If the market starts turning up after failing in several attempts to break higher, then it's usually signal for trader to jump in and buy until the price comes to the next resistance, where trader will either cut its position, depending again on the strategy and trading plan, and just book the profit, or will wait to see the reaction at resistance level. If it signals that it's resisting attacks, means that the long position needs to be cut, or if it shows that the market is tending to break through resistance, it means that the initial direction may extend, so it will be a signal for more profit for traders. So depending on the situation at the given moment. So there are various types of traders, but all of them are looking to support the resistance as some of very important and interesting points that could give a good trading opportunity. Some traders will be looking for reversal when the certain resistance or support manages to contain to resist several attacks, and the market is attempting to change direction. So it's a good signal, market reversal. Then it's a good opportunity to enter the market in the opposite direction, catch some profits. Usually we can see this on formation of certain candlesticks patterns that are usually signaling reversal, or simply market gets indicators get overextended on either direction, and the signal that some correction, if not reversal, will happen. So it's a good opportunity to enter the market, while some traders are looking for breakout, and they jump in the market once it shows that it's breaking through support or resistance. That is signaling usually signaling continuation of the existing trend. Traders need to be aware of certain things. We are going to mention it later on, that could be false break. So you have to be aware of this, that market may make several ticks through the support or resistance, but at the end will not break. So this could be tricky, and the trader needs to take certain steps to protect his position with the, I would say, minimum loss, or with the stop loss order, just in case of a false break. But usually breakout means triggering stops below or above support or resistance, and this usually accelerates the market, and it's a good opportunity to enter. Also, this is what I mentioned. There are a number of stops, and usually traders park stops below or above certain significant points, support or resistance, having in mind that this is a strong level and might not be broken easily. The market may face difficulties or even may reverse. So I'm quite safe. My stop is quite safe below this level. Not to happen that you are in the uptrend and some ticks down, it just goes and collects stop orders which are above the support level, and then continues its direction, which usually happens to the small traders. So big number of stops are usually parked below or above support or resistance levels, and traders who are looking for enter market on breakout know what they are doing, because triggering these stops usually sparks strong acceleration, either direction, up or down, on collecting these stops. So it increases demand or supply depending on the direction of the order, and then of course pushes the market in the desired direction. So if the strong support is broken on existing downtrend, this downtrend will accelerate further, because there are plenty of stops on the long positions, meaning selling. So if you have a few thousand lots for selling below significant stop orders, a significant support level, and they are triggered, that means that there is a strong supply, strong offer, and the market will of course accelerate lower. And the traders who are trading the breakout are looking exactly for this. So when the significant stop is taken out, market would accelerate easily for another approximately 100 points or so, just on triggering these stop orders. The same situation is in the opposite direction. When the significant number of stop orders is triggered above the strong resistance level, that means acceleration higher, and that means continuation of existing uptrend in this case. And those who look for a break, usually they put their orders some points above, maybe 10 or 20, depending again on the techniques, depending on their decision, depending on their risk policy, but usually away from order enough to avoid these false breaks, because it happens that the market moves 10-15 ticks above the resistance several times, and then at the end of the day closes well below. So we call this false break, and usually many traders get trapped with this because they get stuck with the long position entered above the resistance levels, but market decided to reverse after resistance managed to hold all these attacks, and they get stuck, and then they have problem with their position, which is running into a negative balance. How it works, market attacks these levels in the movements. So market is moving in certain direction and then approaches important or less important, depending again on the strength. Reaction usually depends on the strength of that level. So more significant stop or more significant part of support or resistance will produce stronger reaction after either being breached or resists attacks. So markets attack these levels, and several ticks could be seen before it bounces higher, for example. That proves that the market was the current existing direction, the market in existing direction was just testing this level, but eventually at the end of the day it reversed opposite direction. So support managed to hold, or resistance survived attacks, and then the market turned to the opposite direction. And you can see a number of shadows of the candlesticks at certain support resistance area, and usually longer shadows mean that they were stronger attacks, but without success, and usually that could also form so-called technical patterns called bull or bear trap, when the bulls or bears general direction of the market gets caught there without clear break and reverses higher. So this is a good signal in the opposite direction for those who are going looking to enter in reversal. You have to be aware of false break, that already we mentioned, as false break can be shown in the chart as several ticks lower with the longer candle shadows, but at the end proves that the break was not real, and the market reversed in the opposite direction. Now, I think I mentioned, but we have to say that more tests of certain support or resistance level, especially if they are unsuccessful, means that this level is stronger. So if you have 10 attacks at certain point, that means that the level is quite significant. 10 unsuccessful attacks, support or resistance, not important. That means that that level is very significant, and the market in the future will face big difficulties to eventually breach through this level, or it may just reverse. So we have to be aware of this. More attacks and unsuccessful attacks means that the level is very strong and could provide us certain security in the assuming that it might be broken. It gives us a signal that it will likely stay intact, and we can expect in this case reversal of the market to the opposite direction. On the other side, the firm break through the support and resistance. Firm break refers to break through, and usually daily close or 2 daily closes below or above support resistance levels. That gives a firm confirmation that the break has occurred, and the market is going to attempting to continue in existing it's in its existing direction or trend. And as I said, traders usually look for a close above or below these levels daily, weekly, depending on the size of the chart or time frame of the chart that you look. And what is important to mention, we spoke already about this, once we have breakthrough significant resistance level, we generate bullish signals. So if we have, let's say, Ichimoku cloud above the price, and the price penetrates the cloud and then comes above the cloud and closes above this cloud, that's a bullish signal. If the price, let's say, faces 200 days moving average, which is the let's call them one of the most significant for the general direction, that will be good signal that something is developing, that existing direction could extend further. On the other side, breakthrough support level generates bearish signal. So we have again the same story. Once the good support level is broken, we get a bearish signal, and this bearish signal, again, strength of this bearish signal depends on the strength of the support or resistance level. Basically, it's proportional. So stronger support or resistance means also a stronger signal in a certain direction. Once these levels are broken, they revert to the opposite from what they were initially. So if it's a clear breakthrough, significant support, it will become resistance. And the break of resistance will turn that level to support. And again, significance, strength of these broken levels usually applies to their next roll, which is in the opposite direction. So broken strong resistance will now mark strong support, and we can expect that the market will have difficulties to return back, but would rather continue higher because of the break through significant strong resistance through what we mentioned previously, triggering a number of stop loss orders. So we can expect more likely that the market will continue in the original direction rather than moving to the opposite direction. Now, what is important to mention is the type of the support and resistance. You need to know that there are two main groups. They're static and dynamic. So static support is the one where the price, the level is fixed. It doesn't change. It doesn't move. So you can refer to historical highs or lows that are static supports. They are always there. So if the market at certain point returns to these levels, this will mark support, and it will be there until it's broken, until it loses its role. So once it's broken, it becomes resistance. Support, broken support will become resistance, and vice versa. Now, dynamic ones, there are various technical indicators, moving averages, things that are changing, and moving pivot points that are changing, that are moving, but still providing support and resistance. So let's take a quick look at the live chart and see how it looks there. So first thing to see is, in this case, we have an uptrend. So we can see that market attacked here twice without break higher, and then break lower, and then bounced higher. So this marks this candle, the second, the green one, big one. It confirms us that there is a reversal, that support resisted. There were two attacks and rally higher. Now the quite steep rally was most likely running out of steam, getting overbought or whatever, and the traders were taking profit because quick acceleration higher means that it's a quick profit, and it's always good to book it, to take it rather than keep it floating, because you don't know what the market will do next. So we need to see these levels. Now, there was one attempt higher which was unsuccessful. We can see the long candle of this or long shadow, pardon, of this candlestick, dip lower, rejection lower, another attempt higher. Now we have two attacks again without success, and then move lower. So we can see the significance of these levels which were attacked more than once. We can see here, let's say, and here, that base, so-called base, was formed. There were several attacks. Here we have double bottom, for example. This is chart pattern, bullish chart pattern. So we have first signal that the market attacked several times this level, support level, without success, left two lows approximately at the same level, and very likely a reaction will be bounce higher, and it resulted in this. We have the confirmation once the price breached levels of the top of this ceiling. You can see it of the green rectangle. The top of this shape shows us the top, the ceiling of this congestion. So the market, the price action was congested here, consolidating without clear direction. So we had support here, we had resistance here, and usually when there is congestion or range trading, then we are looking for other indicators that will show us what will be the next, because the market is directionless. Market doesn't have a clear direction signal, and it needs some catalyst, needs some signal to spark fresh movements. In this case, the market moved higher, so we don't have indicators in this chart. It's just showing the levels, so we have to say that market moved higher. Our signal was a breach above the congestion top, congestion ceiling, and the price accelerated higher. So this gives us confirmation that double bottom was left there. A higher base was left here. So we have a low, higher low, or higher base. In this case, higher base. What does this tell us? What does this tell us? It's an uptrend. The market is moving up. So we have series of higher highs, higher lows, and higher highs defining the uptrend. So, and the stronger support level, a stronger reaction will be. So we had the double bottom here that signaled us, and we got confirmation of break above this congestion, and the signal was moving higher. Now we have congestion here again. There is still no clear signal what will happen, but it's quite possible that the market may fail here to break higher because of various things. So let's add some let's add some indicators to see how the things will be moving, what we can expect in the near term. Let's put some moving averages that will give us dynamic support and resistance levels. So let's put the next one 20. Let's insert 55 days moving average. And let's put 200 days just to have what does this tell us? Moving averages are in so-called bullish setup. They are all below the price action. They are all ascending. They are positioned according to their number of days according to their speed. So the fastest is the first, the second fastest is below, then the third one, and then the one that gives general direction is far below, but it's pointing up and the price action is above. Recall the class with the moving averages. The main principle is what we said, that as long as the price holds above this moving average, this is positive signal. Once it breaks, it's a negative signal, and breaking a number of moving averages increases this negative signal. So what we have from moving averages here, first support is, this is dynamic support now, 10 days moving average 101.21, the price currently at 101.70. So the downside is so far protected as long as this 10 days moving average stays intact. Now we can talk about deeper pullback, but initial bullish stance will be dented if the price closes below this one, but we'll still not have firm reversal signal because we need confirmation for this. So let's take a look at other important support resistance levels. Let's take Fibonacci levels, or let's make it a bit smaller because we have the bull leg from here, let's say 95.90. So our first dynamic support is at the moment at 101.23, 10 days moving average. Then we have 23.6% Fibonacci retracement at 100.71. We're still above these things, so still we can say, and all the moving averages are moving to the upside, so we can say that the market is still in uptrend. There is still no risk towards the downside, so our supports hold. If we now add, for example, Ichimoku studies, let's just find them. So this is 30 minutes cloud. So the cloud is ascending, it's supporting. The red line is Tenkan Sen, it's also ascending. Blue line Kijun Sen is ascending. So we have several factors that support our idea that the market may extend higher. So we are looking for further upside according to our support levels. Let's take a sample of other support or resistance levels. In this case, we have the instrument which is in uptrend. So we draw the first trend line which connects at least two levels. So it's called so-called tentative trend line when it connects two levels. When it connects to three or more, it's confirmed. But two, let's say, gives us certain indication. So this is our line one. The market increases the angle of ascending, so we can draw the second support line, and we can see that this line contained the corrective action here. Again, we can see here that the market showed a strong resistance. Here we have a long upper shadows before it moved lower, but it was just correction because initially the market action was in an uptrend from the beginning, and then market entered the steep ascent, and we can draw the third line. So trend lines are also acting as good supports or resistances. In this case, we have trend line supports, and you can find it in a number of technical analysis comments. Trend line support lies at this level, and be aware that it's quite significant, it's quite strong, especially if it's longer trend line that covers longer period of time, means that the market had a number of attacks without success. So it means that support is strong and strengthening, of course, until the price gets exhausted, and will signal us that something is going wrong with that direction, and likely correction or reversal could occur in the coming sessions. But we need to get these signals. So we have in this case trend line support, which offers us initial support 100.72. So we can rely on these things, but you can see that the market moved, and was contained and then moved higher. So we need to follow to track this. We draw another trend line that gives us more detailed outlook and more better signal. And then the third one tracks this steep uptrend. And as long as the market price holds below this trend line, we have no fears of any reversal. Of course, if it attacks, we can consider that this is support, significant support, and we have to see the reaction of the market on this support. Now, what we have for static supports, historical levels or historical highs, historical lows. This is the price of the crude oil. We can see the low of June 2017, $42.04 per barrel. Since then, the market action, actually, I can show you that there was a much stronger move. This is, for example, 2008 high, 147.85. This is a very significant resistance. And if the price, for any reason, comes again to this level, it will have quite a lot of difficulties to break it. Why? Because steep rally that preceded testing this level, steep rally before hitting this level was followed by even steeper and stronger reaction on the opposite direction. So this marks very strong resistance. Let's go back to our level. So we have 42.04 level of June 2016. Pardon. Where are we standing now? June, I do apologize. This is February 2016. So this is historical level, very strong support. Then we have June 2017 at 42.04. We can see that during the period from June 2017 until approximately September 2018, the price rose significantly, hit levels at approximately $77 dollars per barrel. I do apologize. We had two attacks here. Let's magnify it a bit, and we can see that the first one had the longer upper shadow. The second one had even longer upper shadow. So there was sort of a false break, which we realized once the price accelerated lower. So the first long bearish candle confirmed to us that resistance managed to cap this uptrend, and most likely reversal will occur. Why? Because it left double top. Okay, the levels are not equal. There is a difference, but two strong resistances, rejections at these levels usually signal that the market will very likely change direction. And then we had this steep fall. Now we're coming back to this historical level, static support 42.04. Market dipped in December 2018 to 42.36. This was the lowest. So we're talking about some 30 pips difference, but support acted well. So no matter that it happened 2.5 years before, part of the year and a half before, it's still acting as a good support, in this case support level, and contained this steep fall, and the market subsequently bounced strongly higher. What we should also consider in this case, formation of candlestick patterns that usually signal some reaction at certain important levels. So we have a long bearish candle. Then we had a long leg doji candle. We talked about this in previous classes. Means that there is very strong decision, and longer shadows, longer legs of this candle increase the intensity of this signal. So a very strong indecision was shown here, and the next candle was long green. So we have formation of bearish doji reversal pattern, which added to our signals from our strong historical low support and signaled reversal. So in combining all these signals, we can get a much clearer picture. But what is the point, since we're talking about support and resistance, is that we had historical level here that was left sometime that was left in 2017, and it was not broken, but market rather bounced higher and then retested this level again without success at the second attack. And this tells us that we can rely on these supports, especially that we had formation here of reversal signal and the chart pattern, candlestick pattern reversal signal, which resulted in this level. Now we're following the move that happened after a bounce from 42.36 support. We draw the trend line that tracked this rally. Rally peaked at $66.58 per barrel. So we're talking about US WTI crude oil, and subsequent reversal broke through the trend line. So we have initial negative signal that is telling us that the price action may return reverse from this level. That may be in reversal. We're going to consult again Fibonacci levels as a very relevant study, which gives us exactly the points which are strong supports or resistances. In this case, supports, and we can see that the fresh weakness from the top at 66.58 tested and cracked briefly 38.2% Fibonacci retracement. We mentioned in our class about Fibonacci that this is one of the key levels. So breach of this level means that a reversal is very likely, and we can expect the price to go lower. So we have a breach of initial support, trend line support. We had the next support 23.6 at 60.86. If you want to mention, there is a round figure or psychological support at 60.00. Usually round figure levels on any instrument are acting as support or resistance, depending again on the figure. Let's say 1 parity level is usually very strong psychological support resistance, usually in Forex. And then we had cracked our 38.2%. So there is a signal that something might be developing. Now again, we have sample of Fibonacci retracement levels, which are in this case again acting as supports. We can see breach of a number of Fibonacci levels. The last is 76.4% retracement, which was cracked today. There is still no clear break. Clear break, as we said, means a daily close below it. That would open way for a final push towards this significant low, which is at 2.5420. But strong signals were given, confirming actually. We're giving confirmation on break of these Fibonacci levels, especially on break below 38.2%. Now, when we spoke about broken support that turns into the opposite direction, 38.2% Fibonacci retracement is a significant level on either direction, support or resistance. In this case, it was good support, but this steep fall, big acceleration in one day, which was not seen since probably December 2018 or even more, because this candle looks to me even longer, dipped to some points to 50% and then reversed higher. We can see several attempts to break. There was even one close above 38.2%, which now reversed to resistance. But finally, fresh these near-term bulls that appeared from this low ran out of steam and gave up at this level and moved lower. We can see the long upper shadows that also signal that there were ticks, but failing to sustain this break, to hold and to extend it. So there was some tick higher and then quick reversal lower. So the resistance, former strong support reverted to strong resistance and managed to cap upside attempts. Again, 50%, which marks the half of the entire move, is also significant. We had breach here. Actually, we had several attempts. We can see here with the long spikes, lower the long shadows without break, and then eventual break. And then the market was held by next significant 61.8%. Again, several attacks without success, and then bounce higher. And very significant here was left dodgy with the long upper shadow, signaling that the market rallied above this level, but was unable to hold these gains and just quickly reversed back and continued lower, and eventually a breach of 61.8% Fibonacci retracement confirmed a reversal of this up leg. So it's almost over because 76.4% is taken out, and as we can see, there is no significant obstacles, at least on daily chart, on these levels on the way towards this our key support on this time frame at 2.5420. If we take a look at the larger time frame, then we can see that this support at 254.20 has another historical low at 255.10, so it's slightly above. It's not we're talking about some 90 pips, but this area is now marking strong support level. And then next one, historical low, we have at 247.20. Okay, this is a bit far, but it should be considered as solid support. Another thing that is important to show the chart patterns that usually signal something. So we had the price in a steep ascent, hitting one point where it failed, brief pullback, and then the bounce higher. And then here we had several attacks, congestion. Usually, as we said, congestion could result on either break up, continuation of, if in case of uptrend, or reversal down, meaning that there is a reversal. The market managed to find support, and then we can figure out what was the support. Let's say from Fibonacci level, it was slightly below 23.6. Maybe we can fine tune it by taking this level, so it's around 38.2%, and then bounced higher, stalled again, and then eventually went lower, and it formed a head and shoulders pattern. Head and shoulders pattern is a bearish reversal pattern, so we have additional signal that market might be reversing from this initial uptrend. What we need to see is a breach of this neckline of the head and shoulders pattern, and the first signal will be given. We had already a brief close below 38.2%, but subsequent bounce higher did not confirm this, so we are looking for the next break and close that will confirm, and the signal on breaking of this strong support will give us a signal that market is going in the opposite direction. Now, what else we have from technical indicators that gives us important signals? Let's see here. The market hit certain level 3 times. Then we had one strong spike higher. You have to spot the red line that is moving. This is 200 days moving average. The market tested this, cracked it, broke a bit above, but subsequently quickly reversed lower, meaning that there is a strong resistance and a strong lack of steam and strength to eventually break this level. We left a dodgy candle with the long upper shadow. Again, there was formation of a dodgy reversal pattern, 3-day pattern. First candlestick is green, bullish, second one is dodgy, and the third one is again red. So we had series of red, so we confirmed this reversal. Now, what is important? The trend is going down. It found support at these levels. We had 2 attacks without success, and then the market is moving higher. Now we have hammer candle here. Actually, it's inverted hammer, but it's still bearish reversal pattern. So this is signal that something is developing. What else is important in this case? We have the bearish divergence on daily slow stochastic. If you see the green trend line, it is ascending in this case. We can make it a bit bigger. So the green trend line is connecting 2 lowest points, is ascending. At the same time, the market action is moving lower, and the trend line that's supporting is descending. So basically, the indicator itself is diverging from the initial direction and signaling that the market is likely going to reverse. And then we had the strong support here, and several signals that gave a signal that market is reversing. Again, trend, the move to the upside showed again the bearish divergence. Part of this was bullish divergence. Now we have bearish divergence of daily RSI. We can see the line is flat in the sideways mode, while the price action is still ascending. So it's signal that indicator is diverging from its price action, and price moved lower, and signaling that there was a reversal. So signaling that resistance, there was again approach to 200 days moving average dynamic resistance, which was not taken out, and the price moved lower. And there are a number of samples of support and resistance. In this case, we have continuation of the downtrend. We can see the nice bear channel. Then we had the area where the price attacked several times. They were long shadows, but it was also congested at the upper side, and failed to break above, and eventual break through the support line signals that there is a continuation. And I think that will be all for today.